All right, let's jump straight into a totally cinematic thought experiment we're exploring today. We're going to be looking at the deep and honestly kind of hidden fragility of global economic confidence. We usually think of markets as just numbers, charts, and logical reactions to whatever the Fed does. But what happens when that logic just totally breaks down? What happens if a single event triggers an emotional shockwave so huge that it literally alters how we view money, safety, and trust? Think about it. What if gold stops behaving like an asset and starts behaving like a blaring warning siren? We're talking about a scenario where a chart doesn't just, break its technical resistance levels, it absolutely shatters established financial narratives right along with it. When gold goes completely vertical, it forces the entire financial world to just stare at their screens and wonder if this move is actually a massive red flag. Because at that point, it isn't just about a price going up, it's about what that price is desperately trying to tell us.
So to really wrap our heads around this, let's set the stage. The hypothetical catalyst we're looking at is super specific. Picture this. It's July 29, 2026, and the Federal Reserve has just announced they're holding their target interest rate range steady at these very familiar numbers, 3.5 to 3.75%. Now, under normal circumstances, that decision alone is enough to make investors lean forward. But in this scenario, it's the spark that sets off a completely unprecedented reaction.
Normally, after a Fed hold, you'd have analysts politely arguing over the tone of the press conference while traders map out their incremental next moves. But instead, we get a parabolic reaction. The candles just keep stacking vertically. Resistance levels, they literally disappear. The move becomes so frighteningly aggressive that people stop asking if gold is a good buy and start asking if something deep inside the financial system is fundamentally broken. Every single rising green candle morphs from a simple price point into a direct, undeniable message of no confidence in everything else.
Which brings us to our first major shift, when smart money panics. Let's look at how this builds tension among the quietest players out there.
See, the very first people to panic in a scenario like this wouldn't be the loud guys on financial TV. It would be the quiet, careful ones. We're talking long-term portfolio managers, macro traders, and family offices. The private wealth managers for the ultra-rich. These are institutions that literally pride themselves on never acting emotionally. They don't move billions of dollars on a whim. So when they start aggressively flooding into a safe haven, it signals a massive structural concern. They're watching this explosive move and wondering, hey, has inflation been drastically underestimated, or is the Fed's credibility quietly slipping away?
And that leads to a pretty profound realization. In an environment like this, the price itself actually becomes a referendum on trust. Trust is the real asset we're dealing with here. Gold has always lived in this weird space between being a commodity, a currency, and a psychological shelter. When these massive institutions push the price vertical, they aren't just chasing returns anymore. They are actively fleeing doubt.
Next up, the fear becomes contagious. Let's see what happens when that institutional doubt starts spilling over.
It kicks off a true contagion cascade. It's like dominoes falling. First, gold accelerates aggressively, but it doesn't happen in a vacuum, right? Silver follows right on its heels, and mining stocks suddenly spike. Then, the real foundation starts shaking. Currency markets begin to wobble, and suddenly, the mighty US dollar is looking a little less invincible. Even bond traders, who are usually the most cold, analytical people in the room, start getting visibly nervous. What started as one single mundane Fed decision has mutated into a global emotional event. And before long, the public wakes up to it. A parabolic move in gold is an absolute headline magnet. It dominates the news cycle, it spawns viral clips on social media. All of a sudden, people who have literally never thought twice about precious metals are rushing to buy into ETFs and physical coins. You'd probably find yourself wondering if this is a sign that the whole financial landscape is shifting. This kind of fear spreads like wildfire, because in a parabolic market, everyone is just reacting to everyone else's reaction. Standing still and doing nothing suddenly feels like the biggest risk you could possibly take.
So, where does that leave the folks in charge? That brings us to the central bank dilemma.
Now, central banks obviously wouldn't publicly panic, but a dynamic like this exposes their absolute biggest vulnerability. Sure, they have the tools to manage interest rates, but they cannot control what people believe. If gold is screaming upward right after the Fed holds rates steady, the glaring takeaway is that the market flat out doesn't believe the pause is enough to fix things. It's their credibility, their core belief system that's actually being tested here.
Meanwhile, down in the trenches, the market completely fractures into these distinct factions. It creates insane volatility because you have everyone crammed into the exact same trade, but for totally different reasons. The fast money crowd, they're just surfing the momentum. The macro traders are trying to figure out if this is a permanent regime shift. The skeptics are shorting the whole thing, swearing it'll reverse any second. And the true believers? They feel totally vindicated that structural fear is finally actually being priced in. This toxic mix turns hesitation into rocket fuel, making the market deeply, deeply unstable.
Which all culminates in this really stark reality. People are no longer just looking for growth, they are looking for shelter. When safety becomes the hottest trade on Wall Street, when shelter is the dominant narrative, the psychology of the entire financial system has fundamentally shifted. The floor beneath the market is literally vibrating.
And that naturally leads into our next phase, the shift to preservation. Let's zoom out and look at the philosophical fallout of this.
The entire conversation around wealth just completely flips. The old mindset of, hey, how do we maximize our returns, gets instantly replaced by, how do we just preserve what we have if the world gets rougher? This isn't just a market rally we're talking about anymore. This is a profound change in worldview, affecting everyone from the biggest institutional asset allocators right down to everyday folks checking their 401ks.
And honestly, this creates a massive symbolic problem for the Fed's narrative credibility. If the Fed gives their carefully worded, reassuring statements, and the market responds by immediately sprinting in the exact opposite direction into gold, it means the market trusts cold, hard metal significantly more than soft language. When central bank words lose their power, paper confidence just evaporates. Once that happens, every single other asset class is forced to aggressively justify its existence. Think about it. Stocks absolutely need earnings growth to hold value. Bonds need yield. Cash requires systemic confidence. And everyday fiat currencies need immense trust to function. But gold? Gold simply needs fear. And as we've seen time and time again, fear is just about the most renewable resource in human history.
Which brings us to our final overarching theme, a mirror for global anxiety. Let's look past the charts for a second.
Because a parabolic move of this magnitude isn't really just about money. It acts as a cinematic reflection of the world's emotional temperature. It's the retiree tossing and turning, wondering if their life savings are going to vanish. It's the young investor totally paralyzed, trying to figure out if this is a once-in-a-lifetime opportunity or a blaring siren to get out. It's the local shop owner realizing their customers are suddenly obsessed with inflation. And it's that late-night trader staring at glowing green screens, realizing the market is loudly whispering its deep discomfort with the future.
In moments like these, gold reverts back to what it has always been underneath it all. It is so much more than just a shiny metal. It acts as a generational memory of distrust. It's a symbol of permanence in a really fragile system. And often, it's a stark prediction that the next economic chapter is going to be a lot rougher than the last one. That urge to hold on to something real, something scarce, it is literally the oldest narrative humans fall back on when things get wildly uncertain.
So I want to leave you with one final, unforgettable question to chew on today. In the wake of that single Fed decision and the explosive reaction that followed, is gold rising because it's inherently strong, or is it soaring simply because absolutely everything else is starting to feel far less certain? It's a question that challenges the very foundation of global trust, and one that should absolutely change how you look at the markets from here on out.